The stock is up 301% year to date, but here's what they're not telling you. Everyone's watching Bitcoin, but there's another story unfolding and almost nobody sees it. Irene recently posted blowout earnings, that's ticker IREN, and I'm just going to call it Irene. Net income flipped positive, revenue exploded, and the stock up 301% this year. But here's the problem. Most people still think this is a crypto miner. They're wrong. This business is shifting right underneath them, and they haven't updated their thesis, which means they're holding it for the wrong reasons, or worse, missing the actual upside. My patrons and I got into Irene on September 3rd. It's up 49% since then, and no, this isn't luck, it's execution. You either had the thesis or you didn't. But this isn't a victory lap, because what comes next matters more than what just happened. There's one thing inside this earnings report that could make or break the stock long term, and if you're not looking for it, you won't see it. Let's break it down. Everyone's excited about the top line. Revenue came in at $501 million, up 168% year over year. Explosive growth, right? But that's not the number that matters. You know what really matters? Profitability. Real cash-generating operational leverage. And for the first time, Irene delivered it. They posted $87 million in net income and a 54% adjusted EBITDA margin. That is not normal for a company in this space, especially not one scaling both AI infrastructure and Bitcoin mining under just one roof. Margins like that don't happen by accident. They're the byproduct of two things: world-class power efficiency, 3.5 cents per kilowatt hour, and scale, 50 exahash of mining capacity running profitably. And despite all the expansion, despite all the capital spend, they kept the operating machine tight. Their average hash price was $51. Their all-in cost, $19. That's a 60% margin spread in a business where most players barely break even. So yes, the revenue growth was impressive, but the real story is this: Irene just became a high-margin operator in a space full of cash burners, and that changes everything. Most investors still think this is a mining company playing around with GPUs. They're wrong. Irene is building the infrastructure backbone for AI, and they're doing it at scale that only a handful of companies can match. Think CoreWeave, think Lambda Labs. Now throw Irene into that conversation. Over the next few months, they're ramping from 1,900 to 10,900 high-end GPUs. That includes Blackwell-class systems, the same architecture used by top-tier enterprise AI labs. And they're installing them inside custom-built, liquid-cooled data centers with locked-in power under 4 cents per kilowatt hour. This isn't a side hustle. This is the plan. They're targeting $200 to $250 million in annualized AI cloud revenue by early 2026. If they land even a slice of that and execute like they did in fiscal year 2025, the market's going to have to reprice the business entirely. Because once you move from transactional mining to recurring AI compute, you own the entire stack. The multiple doesn't stay the same. It expands. Everyone's watching the revenue. Some are even looking at margins, but almost no one is adjusting their framework. They're still treating Irene like a leveraged Bitcoin miner. They see the multiple, they see the volatility, and they assume it's all hype. It's not. The business model is changing. Irene is actively shifting from commodity exposure to capacity-based pricing. And in markets like AI compute, capacity gets a premium, especially when it's backed by owned infrastructure and locked-in power. This isn't a hosting business. It's not a reseller model. Irene owns the land, builds the data centers, installs the GPUs, and controls the operating cost. Power is secured at 3.5 to 4.8 cents per kilowatt hour. Liquid cool centers built for Blackwell NVL72s. Enterprise latency and fiber already in place. That's how you build margin at scale. That's how you separate from hosting shops and plug-and-play miners. But here's the disconnect. The market still values Irene like it's entirely Bitcoin driven, which means every step they take toward infrastructure, margin expansion, and recurring revenue is mispriced optionality. And that's the setup. Let's be clear. This stock is not safe, it's not stable, and if you're sizing it like it is, you're playing a dangerous game. Irene's free cash flow margin is negative 224.9%. Let that sink in. They are burning cash aggressively to scale, and they're taking on debt to do it. Over $960 million in convertible notes on the balance sheet, with interest payments already baked in. You want more? Their PE ratio is 107.59. Their cash return on invested capital is negative 58.1%. That's not a typo, that's the math. And that GPU expansion that everyone's hyped about, it's not fully contracted. That AI cloud revenue, it's a projection, not cash in the bank. If demand slows or if they miss install timelines, the payback window gets longer and the market punishes the stock hard. This thing moves with Bitcoin, trades like a small cap, and behaves like a hyper-growth startup. Combine all three and what do you get? Volatility on steroids. This is not a core holding. This is a high-risk, high-reward, conviction-based position. And if you can't stomach a big drawdown, you shouldn't be in this stock at all. We're making great money right now, but let's not pretend this is safer than it is. Does Irene have a moat, the truth you need to know? If you followed me for any length of time, you already know I'm obsessed with moats, because at the end of the day, this is what separates a hot stock from a real business. A moat is not a buzzword. It's the reason a company survives when growth slows, when competition shows up, and when capital gets expensive. Without a moat, margins shrink, pricing power disappears, and your thesis breaks fast. A moat is what gives you durability. Without it, all the revenue and excitement you're seeing, it's just temporary momentum dressed up like a long-term story. So does Irene have a moat? Let's start with the bull case. Irene controls the full stack. They own the land, the power infrastructure, the data centers, and the high-end GPU hardware. Their energy cost is locked in at rates other players can't touch, 3.5 to 4.8 cents per kilowatt hour. That's a structural advantage. They're not renting space, they're not outsourcing power, and unlike most players in this space, they're not just flipping hardware. They're building capacity that hyperscalers can't scale fast enough to meet. They also have first mover momentum. They've already secured Blackwell GPUs, and they're installing liquid-cooled GB300s before most competitors even have the fiber. If they execute, this becomes a real edge. Now the bear case. There's no software layer, no ecosystem moat, no customer lock-in. Everything they're building is physical, and while that's powerful during a supply crunch, it's vulnerable in a price war. Their AI cloud revenue isn't contracted yet, their customers aren't sticky, and the only thing standing between them and margin compression is execution. If they delay installs, miss timelines, or if hyperscalers flood the market with GPU capacity, this edge evaporates. So here's the bottom line. Irene does not have a wide moat today, but they have a shot at building one if they keep scaling faster than everyone else. If they secure recurring contracts, lock in long-term customers, and hold their cost advantage, then this becomes a business that can compound over time. Until then, this is a high-risk infrastructure play, and without execution, it doesn't scale, it sinks. Let me show you how I'm thinking about this. This business just flipped to profitability, margins are scaling, GPU infrastructure is going live, and they're transitioning from a Bitcoin miner to an AI cloud operator, while the rest of the market is still catching up to that fact. So the question becomes, is this stock investable long term? Here's how I'm breaking it down. Revenue is accelerating, cash flow is volatile but trending positive, the AI cloud build-out is real, not vaporware, and Bitcoin is still a tailwind, not a crutch. This isn't a hype story, it's a company that's getting stronger every single quarter. And if you watched my channel before, you know what I care about. Are the numbers going up across customers, capacity, and cash flow? Yes. Is the product getting harder to compete with? Yes, if they hit scale. Is the business becoming more efficient with every new install? Yes. And that's what I bet on. Now to be clear, this is a high-risk position. The debt load is real, the AI cloud revenue is not fully locked in, and execution is everything. If they slip, the downside is brutal. So this is not a core holding. It's not a safe haven. This is a speculative position with tremendous upside if they execute. And based on what I'm seeing, I'm bullish. This is the kind of setup I look to build into over time, not chase in just one shot. And if the market gives me a pullback, I'll be ready to act. And for now, I'm playing this with options. Now let me ask you something. Who else is breaking down the Irene trade from both sides, not just showing you the upside, but walking you through the cash burn, the execution risk, and the real reason this company might scale into a dominant player? Who else puts the trade alert out before the breakout and then shows you the data, the entry, and the exact execution in real time? Nobody. That's why my accounts are up over $2.3 million year to date with a 67.02% return. That's not luck, that's not chasing, that's strategy, executed over and over again. But this isn't just about me. Steve just crossed $250,000, said it best himself. All thanks to Jerry and his community, because this isn't just trade alerts. It's a room full of sharp investors calling each other higher. And Jungle did the same, took his account from 100,000 to 250,000 in under a year, learned to build wealth, and more importantly, how to keep it. This is what happens when you're in a room where people are leveling up every day. And that's what my Patreon gives you. Real-time trade alerts with full breakdowns and the logic behind every move. Daily strategy updates so you're not guessing in a fast-moving market. And exact entries and exits, no fluff, no delays. Position sizing strategies, whether you're just starting out or managing 7 figures. It's a real community with beginners, seasoned investors, and multimillionaires sharing strategy. When you get around the right people, you make better decisions, period. It's only $30 a month, and people blow that on Uber Eats. This is a shot at long-term leverage. You want to know if it works? My accounts are up over $2.3 million this year, and we're not even through the third quarter yet. This is what disciplined execution looks like. No hopium, no hype, just high-level strategy played with precision. Try it. If it doesn't sharpen your strategy, grow your account, and make you think like a real investor, cancel anytime. No pitch, no pressure. But if you've been watching this channel, nodding along and telling yourself I should probably join, then stop watching. Start building, because the truth is simple. You can scroll or you can scale, but either way, don't say you weren't told.